Well, the UK's economy is clearly in trouble and the Bank of England is responding, cutting interest rates to an historic low. It's the first time they've had to cut them since the 2008 global financial crisis. Well, the central bank is clearly on the move, and Olly Barratt is in London with this report for us.
Bank of England Governor Mark Carney had promised that if the UK's economy showed signs of slowing after the Brexit vote, the bank would act with stimulus. And act it has.
The MPC agreed an exceptional package of measures comprising, first, a 25 basis point reduction in bank rate to 0.25%, a new term funding scheme to reinforce the pass-through of that cut in bank rate to the borrowing rates actually faced by households and businesses.
It follows a series of surveys of purchasing managers in the services, manufacturing and construction sectors that suggested growth is already taking a hit. It's far too early to tell exactly how the UK economy will end up being affected by the Brexit vote. But if the early data is anything to go by, Britain could be heading for a recession. Kevin Gallagher runs a wine import firm. Like many business people, he's worried about the uncertainty as the reality of Brexit is unpacked.
It might be great, but it's more likely, in my opinion, to be at least a great period of unrest for a long time. And as we've heard so many times in the last 6 months, the one thing markets hate is unrest.
There are further options available to the Bank of England to add more stimulus to the UK economy, although negative interest rates are considered unlikely.
So far, the market is really not predicting negative interest rates at all from the Bank of England. Carney's been pretty open in saying that he doesn't believe negative interest rates apply to the UK at the moment.
But even with the bank's help, the UK economy may well be in for an uphill struggle. Olly Barratt, TRT World, London.